Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of the PPF, the Public Provident Fund, how it's reported, how it's taxed in the U.S. U.S. taxes you on your worldwide income. If you're a U.S. citizen, legal permanent resident, foreign national who meets the substantial presence test, if you don't qualify for any exceptions, the U.S. is going to reach in and tax you on all of your income. Doesn't matter if you're living in the U.S., doesn't matter if it's sourced in the U.S., outside of the U.S., 10 different countries. The IRS is going to require you to include all of that income on your U.S. tax return. You may qualify for the foreign earned income exclusion. You may qualify for a foreign tax credit if the facts apply. Public Provident Fund, PPFs as they're called. The way it works, it's a great vehicle tool in India. It basically is tax-free the whole way, but you got to let it sit in there for 15 years. You don't pay tax as it grows. There's some benefits when you take distributions out. But it's a great investment. It's basically used ancillary to your retirement. Okay. From a U.S. tax perspective, they don't recognize the PPF as a form of retirement per se. So what does that mean? It generally means that even though it's growing tax-free in India, the U.S. is going to require you to include the growth within the PPF each year that you're reporting it, that you're a U.S. person. So you're a U.S. person, let's say, and you've got this PPF, and it's continuing to grow and it's generating interest or other types of income within the investment itself, it's taxable. It's pretty much that simple. And since you're not paying any tax on the growth within India, you're probably not going to have any foreign tax credits, which is a total buzzkill. In addition to the tax, there's also the reporting. It's going to be reportable on the FBAR, FinCEN Form 114. It's also going to be reportable on FATCA Form 8938. Probably not going to fall into PFIC territory, but that's always food for thought. You have to look at the underlying investment. Most people can't get that information, and the people who invest in it don't necessarily control how those assets are being invested, so that's why it generally can escape PFIC territory. If you're out of compliance for not reporting the PPF in prior years, there's various amnesty programs available to assist you. If you're willful, you can't certify under penalty of perjury that you're non-willful. You can qualify for the voluntary disclosure program of VDP. If you're non-willful, you have lots of other options available to you. You've got the streamlined program, streamlined domestic, streamlined offshore, reasonable cause and delinquency. We have lots of free information available on our main website, goldinglawyers.com, and we have lots of sub-websites identifying specifics on international tax and reporting to help you weave through some of the craziness and the acronyms that you have to go through. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.